Hi, this is Patrick Henry, the CEO of QuestFusion with the Real Deal What Matters. I'm here today again with Rod Turner. We had a very successful webinar about Regulation A+, kind of a general overview about a month ago. And backed by popular demand is Rod. There were a lot of questions after the webinar specifically about Regulation A+, and as it relates to real estate transactions, and there are some unique nuances associated with that. So welcome everybody on that. For those of you that didn't see the original webinar, Rod is the chairman and president of Manhattan Street Capital. They're a leader in raising Regulation A+ financing for growth companies. And I'll let him kind of give you more background on himself, and then we can jump into it.
Thank you, Patrick. So I have had the good fortune to make a lot of real estate investments over time, actually, of various kinds. But when it comes to Manhattan Street Capital, we've been doing this for 2 years, focused almost exclusively on Regulation A+. I've had a key role in building 6 successful startups, of which 2 we took public to the NASDAQ. One of them was Symantec, the company behind Norton Antivirus, which my team introduced. And so I've had a lot of good relevant experience. With a good friend of mine, we set up a venture capital firm. So I have financing experience based on a technology background and entrepreneurship, which makes things useful. Manhattan Street Capital focuses, as I mentioned, as you mentioned, on raising money for companies using Regulation A+ primarily, and that's our area of expertise.
Cool, that's awesome. There's a rumor out there that Peter Norton still gets like $1 a copy for every copy of Norton Antivirus.
Yes, I'm sure that's true. Probably a little bit better, yeah. Based on the original agreement, substantially better.
I'm sure.
I imagine it may have been renegotiated, 5 or 6 times.
Possibly.
Yes,
maybe he's not getting that anymore, but it was a sweet deal. I can tell you that.
It was.
So, first category of topics I want to talk about is learning how to make the most of Regulation A+. To raise capital for your real estate venture. Are these typically like real estate investment trusts or other type of real estate investment vehicles?
Yeah, they can be REITs. They're being called e-REITs when they're done this way, but they don't have to be. That's a valid mechanism to use.
Okay, cool. Well. And maybe we can kind of talk about that too. For my edification, that'd be great. And we'll explain which steps take, what the steps are to take, and the mistakes to avoid in planning and implementing your Reg A+ offering. So, first question. Why real estate is succeeding with Reg A+, $160 million raised to date, and this is a relatively new vehicle for raising capital. So
yes.
Why the success with real estate?
Yes, so to put that in perspective, that's about 40% of the total capital raised in Reg A+ today is real estate.
Yeah, and that's a single segment, so there's probably at least a dozen or more segments.
Other segments competing, yeah. So it's by far the leader so far. And I think from an opportunity standpoint, consumer investors are primarily funding these companies or investing through Reg A+ at this stage in the process because accredited investors and institutions are waiting for Reg A+ to be proven.
Okay.
So we need to appeal to consumers, and consumers can identify with real estate. A lot of regular Main Street investors would love the opportunity to go out and buy a building, but they don't have the time or the capital necessarily. So being a part of such an investment when the terms are attractive is interesting, and then you have the tangible asset of the real estate itself being involved. So those are the fundamental reasons. I think that the third one that matters greatly to people is most real estate transactions are paying a yield or a preferred return. So for the man in the streets, when you're getting 0.5% if you're lucky on your bank account, in fact, it's an infinitely small number in my case from Wells Fargo. The idea of getting a 6 or 8% preferred return on your investment and having an upside as the project succeeds is very appealing. So you've got a combination of those factors.
So a lot of it then is deal structure. So other verticals could duplicate this success rate potentially if they paid this high yield.
Yes, actually. The high yield thing is something that I've been pursuing, and I'm suggesting that to some of our other companies that aren't in real estate.
Yeah.
And there's entirely legitimate ways to do that.
That's really interesting.
Yeah, it opens up broadens the investor base.
Yeah, I mean, it's like there's some people that don't invest in stocks unless they're dividend bearing, including big mutual funds. You know, they have certain funds where unless you pay a dividend, they won't invest no matter how good your company is. And this is kind of a key catalyst when Intel first started paying a dividend. They've been paying a dividend a long time, and Microsoft and Cisco, and yeah, really, really interesting.
So one other thing to add to that is that everyone, pretty much in the US at least, knows that real estate is on an uptrend. Interest rates, probably most people would say interest rates are not going to be going up to, you know, very high levels anytime soon. So in this environment, one can feel like this is going to be a good place to be. Real estate is it's going through a very positive phase where people are frustrated that they can't do more.
No question. I mean, interest rates are so low, even if they went up by 50%, which I don't think anybody's predicting, they would still be historically massively low.
Right.
I mean, that's how low they are. It's pretty incredible.
Yes, indeed.
Now, getting financing is a different story, but that's probably a topic for a different day.
Yes, and that's gradually normalizing, one is led to believe.
That's good. That's good to hear. So what are the upfront cost and total cost of a Reg A Plus offering?
So, for a sizable transaction, and I think frankly Reg A Plus is appealing for real estate, and in many instances for the larger sums, then there's a slight increase in the fees. But essentially you have to have an audit first, and that's going to vary depending on, you know, is this a brand new entity that you set up, in which case maybe $4,000 for an audit that is a part of the filing. And then the legal service provider, say $50K minimum per Reg A offering, and then the marketing preparation prior to going live on a marketing agency, creating videos, creating graphical content and text, testing messages, building social media presence in order to launch and have rapid success with the raise to bring in investors. So the largest expense of that is the agency. So at the low end of the range, 100K, and at the higher, you know, the higher end, maybe 200K of upfront expenses for a much larger raise.
So these are kind of specialized PR agencies that are working in this area or have a specialization in this area?
Yes, it's I like to call them 360-degree agencies because they're covering PR and advertising in the traditional digital sense, as well as social media advertising and creating videos, a lot of content creation, designing a very attractive offering page and a short, compelling video. In actual fact, there's a lot in common with donation crowdfunding at this stage because we're appealing to consumers just like they do on Kickstarter, albeit, you know, it doesn't resonate, it doesn't compare to a whole raft of smaller offerings that are doing music and things.
Sure.
But on Kickstarter, a company that has a gadget that's raising millions and millions of dollars of donations as pre-purchases, essentially, you're appealing to consumers.
Okay.
Who love what you do.
So it's running Facebook ads, you know, SEO type of stuff on Google, content creation, all the traditional kind of digital marketing stuff that you would do and any kind of thing. But this is very targeted and specialized towards raising money, doing equity crowdfunding offerings.
Yes, exactly right. And there are a limited number of agencies that are good at that.
Yeah.
And we have selected 4 of them and work with them.
What makes them good?
Practice, project management, because you're juggling so many different components and they all have to work at the right time, and efficiency, cost efficiency. Because frankly, if you were to take these tasks to a traditional marketing agency, they're on a whole different wavelength. You know, they're thinking 6 months to a year to build the brand. You know what I mean? You've been there.
Yeah.
This is very different in terms of those things: project management and cost efficiency.
And what about how does Manhattan Street Capital get paid? You know, is that because that's obviously that there's a cost associated with that as well?
Yeah, so because we're not a broker dealer, which enables us to charge lower fees. We are not allowed to do the marketing. We're not allowed to promote our offerings as Manhattan Street Capital. The agencies are. Okay. So we introduce the agencies and we stay engaged and help baby the process, project manage the process and consult with it consult with the company along the way to maximize the likelihood of a successful outcome and maximize the cost efficiency of it.
Okay. So you take a percentage or something like
No,
that?
we can't do that. That would be lovely, but because we're not a broker-dealer, we charge $50 for each investor and $50 of warrant coverage, which are like stock options for each.
So there isn't a requirement for a broker-dealer in a Reg A Plus offering transaction? I mean, because that, from taking Entropic public, I mean, that is a huge expense, and you have to be with broker-dealers because they have the relationships and they have the trading capability and everything that. So it's really essential. So this is on the legal, on the PR, potentially, on the audit, and on the agency side, what the broker side, broker-dealer side. This is a massively lower cost way to raise large sums of money versus an IPO.
Yes, I mean, actually, I think that the percentages start out when you involve a broker-dealer, it's around 10% of the capital raised in this form, in Reg A Plus, where the amounts are smaller. So you wouldn't really be able to raise the money at all in the past. It was a private placement, and there's only $1 billion a year of that happening in the whole of the US. So it is cost effective for the size of the offering relative to an IPO that you couldn't do anyway.
Right.
But on the broker-dealer thing, though, I want to mention there's some important aspects here. They can add an intense amount of value once the retail transaction is already successful. Then they'll bring in their clients. Once it's a no-brainer, it's a low risk for them with their client relationships.
Sure.
And they open up some, quote, problem states where it's difficult for companies to sell shares into Texas and Florida in particular because they are not cooperating with the SEC. So there you're talking 14% of the US investing public. You get access to them easily with a broker-dealer. So having a broker-dealer on is great. There are some complications, particularly to do with FINRA at the moment, where the process of getting the deal approved by FINRA can be unpredictable and sometimes very slow.
Whether you use a broker-dealer or not?
No, only with the broker-dealer.
Only the broker-dealer,
because
interesting.
by having one, then the terms that the company has negotiated with the broker-dealer have to be approved by FINRA, which is entirely appropriate, but that process is not as smooth and predictable as we want it to be.
Does this deal with things like liability and having a fairness opinion, or is there other?
No.
What are the holdups with that kind of approach?
I think that at the end of the day, it's that each deal is generally a little different, and then you're dealing with different examiners at FINRA, and I guess it would be neat if they had more employees doing this, probably, or something. I have no.
So it might be like the patent office, where things are just bottlenecked because they're kind of.
But then you hear about transactions getting through very smoothly too. So it's that inconsistency. So if you're dedicated to having a broker dealer, then you can do it, and the terms can be very reasonable. They have their upfront fee and they have the percentages they charge, which most companies are happy to pay. The only issues are, the primary issue is what I mentioned with this FINRA process. And if you get far enough down the process and it's still delaying, then you can choose to remove the broker from the transaction. Or it's going great and there's no problem. But just to highlight that fact, it's a double-edged sword at the moment.
And then, as I understand it, you can do multiple closings. Is that right? When can you do a first closing?
So if you're buying a building, for example, and the price is $20 million that you have to raise, then you cannot do a closing until you hit 20 million, obviously. But if you are doing a grow the business strategy where you are going to buy buildings, which is what Fundrise did, then you do not have to have any particular buildings in mind when you start, and you don't have to have a minimum. You can have zero minimum. That's regular. That's the normal process for most Reg A offerings at the moment. Unless you're buying a business or buying some other asset, in which case you can do the first closing after 5 days, depending, or 2 weeks, depending on how much capital you have raised.
Do you have to state that in your upfront filing?
No. The zero minimum states it. It basically says that if we were silly, we could raise we could close when we have $1,000 of invested capital.
Okay.
No one would do it because there are transaction costs every closing you do that
Okay.
aren't excessive, but
But you still have an open-ended deal here up to the maximum that you stated
Yes.
in your offering.
Yes. So you end up waiting until there's enough money to justify doing a closing.
Okay.
Waiting until everything's clarified and there are no issues. And if there's some concern about a couple of investors, then you would not close on those investors. You would close on the others.
Okay.
And
Interesting.
do that closing and then move on to the next one. And you can also, what's more exciting really is more real life, is that you can set a maximum of 50 million, raise the 12 million you need now, and then pause the offering. Don't
Yeah.
close it, but pause it and come back 3 months later at a higher valuation because the business has moved on.
Okay.
And you've grown it, you have assets now and real estate that is performing and that is partway along
Yeah.
through its journey. So entirely reasonable to turn it off and turn it back on. Okay, we've taken enough capital right now, so let's pause it. That's entirely reasonable. Fundrise is the best example so far.
Yeah.
Once they've proven themselves, they opened one of their funds and raised $5 million in a few hours because they had already got a lot of pent-up enthusiasm
Sure.
for it.
Interesting.
They've raised about 140 million at
Wow.
Fundrise on 3 funds,
Wow.
geographically
Over what period of
dividing.
time?
A year.
Okay.
Approximately a year.
Wow.
Yeah.
Wow. That's really
And they did
impressive.
literally, they raised money and paused it, and then raised money again and paused it. And this is real life, and in a way, I think it's what investors want to see,
Yeah.
It's real, We're not trying to get all the money now just in case we can use it.
Yeah.
We're taking as much as we can deploy. We'll deploy that, and we'll come back and reopen.
Right.
That's fair enough. That's more sensible.
Sure.
Yeah.
Yeah, and it allows you to establish a track record, which, is very important for a lot of investors.
Yeah, then you can-
build confidence and
Yeah.
interesting. So I'm here with Rod Turner, the chairman and president of Manhattan Street Capital. We're talking about Regulation A+ as it relates to real estate. We are taking questions. If you have any, definitely shoot them in, and we'll go from there. Now, one of the things that was interesting that you brought up there is about the broker-dealers. Do they see you, I mean, this is a general statement, I had to make generalizations, but I'll put it out there anyway.
Yeah, yeah.
Do the broker-dealers see the Manhattan Street Capitals of the world, these fundraising platforms, as being competitive with what they do? Complementary, competitive, how do they view it, or is it a mixed bag?
It's a mixed bag. Some of them think it's a concept and that you could never raise money online of any significant amount. Obviously, that's been disproven, but some are still kind of that mindset.
Okay.
And some of them we're working with, and we have arrangements, informal partnerships with, where we're helping each other, we're helping them, and others that I refer companies to that are a misfit for us.
Yeah.
And partnering with them for our companies. So there's a handful of great broker-dealers in Reg A+, and we work with them and are pleased to do so.
Okay.
I actually hope over time that some of the broker-dealers, as they get attracted to the idea of building their own platform, will realize how difficult it is and then partner with us, because
Okay.
I'd like for us to be getting a significant amount of that kind of business where they've done the tire kicking, they know the principles, they may
Sure.
have worked with them for years. Let's work together.
Yeah.
We've already got a validated business. It helps both parties.
Cool. So how long does it take to complete a Reg A+ offering typically?
Yes, so you're allowed to continue raising money theoretically for 2 years, but it's really 1 year, and then you have to refile. So
Okay.
up to 12 months is the total amount of time from when the SEC qualifies the offering first. The process of, once the audit is done, and that's going to depend on the company and
Sure.
the auditor, once the audit is done, then the marketing preparation and the filing with the SEC is 60 days approximately. So 2 months to get ready after the audit, and then you can be raising money the first day after that. So then say month 1 is when you make a substantial closing. Maybe that would be 20% of the raise, 10% of the raise, enough to make it interesting and to pay for the ongoing marketing costs. And maybe an offering where it's gangbusters and we're trying to raise the money all at once. If it's a bigger number and it's a more challenging offering, it might take 6 months of live offering after 2 months of preparation. Or if we're very lucky and it's really a no-brainer, you know, and it has not only that this is a good investment, but it's like, I want to live there. You know, I want that place. I want to be in. Can I get a deal to buy one?
Yeah.
You know, then that's going to happen faster. So maybe 60 days of raising capital, and it's all adjustable. You know, you don't start out with huge marketing spend in the first weeks because you're tweaking and adjusting it and setting the parameters correctly. And when you have it working at maximum efficiency is when you turn up the burners, right? And then you know what's working, and generally it'll work consistently for some time. Unless you tap out the market, which with real estate would be hard to do, I think.
Yeah. So with, you know, kind of now that you've done some of these deals, are you seeing any patterns or trends develop, you know, especially let's say within the real estate segment where you're saying, okay, this is how it looks like is best practices and what typically happens?
Yes. So one of the things I want to make, there's two particular things I want to make clear so I don't forget them.
Okay.
One is that you are allowed to contribute as an investment a piece of real estate that you own.
Okay.
And so some companies are interested in this where they do what they do now. They raise money, typically it's been a Reg D transaction.
Sure.
Or they have a pool of investors they go to, and then they borrow money and buy a facility, upgrade it, improve upon it, and then it's ready for sale, it's producing at a higher rate. And they will sell it into the marketplace. Now you have the option to set up a Reg A fund that will buy that building and other buildings that have been through your first process, and you can stay involved and make money on them thereafter.
Okay.
Yeah. So using that method of contributing those assets at fair value, probably properly valued, is a totally legitimate thing to do. And it opens up a new avenue for companies already successful in real estate that have had to let them go because, you know, there's a limit to how much capital you can lay your hands on at any given time.
But that's a tricky proposition because fair value, you know, is typically determined by some type of arm's length transaction. I mean, even if you go out and get an appraisal on a building, that isn't necessarily what's reflective of the market. So, you know, if I'm like, okay, I'm going to sell it, I'm going to cash out, but I'm going to contribute on the upside with an arm's length transaction, how is that regulated?
Well, the SEC looks at that and they say it has to be fair. It cannot be a conflicted transaction. So then it's up to us, really up to the company, to determine a fair system, and we'll help advise them to the extent we're allowed to, right? Because we're not valuation experts. There are professionals that are great at that. But at the end of the day, it has to be fair. So a chap I spoke with yesterday at a very successful real estate developing company, he said, okay, we'll get 5 valuations and we'll discard 1. And we'll take the average of the remaining 4.
Okay, and that's going to be their justification and hope that that holds up if it's challenged at some point.
So when I discussed that with one of my I say my, and they're not owned by me, but one of my favorite SEC attorneys, expert attorneys that deals with the SEC, they were not concerned that it's possible to construct a fair system that will pass muster. Of course, anything is a risk, right?
And all that stuff is disclosed in the offering. So, you know, somebody's going to see that. They're going to see that, you know, the red herring, so to speak, and say, okay, this is what's going on here.
It has to all be above board, and writing those disclaimers properly is key. But to get to the other aspect of the question that I think you asked, that was about nuances of these transactions. People tend to be confused about how you do it. How can you do the Reg A? The way to think of it is it's a plug-in investment engine, and all the rest of the structure that companies are used to can remain. So you have an advisor selecting buildings. They don't have to, or real estate, they don't have to be a part of the Reg A entity. You know, as is the case now, if you're doing a Reg D offering, raising money, the advisors do not have to be a part of that.
Right.
Yeah. So you structure a very similar mirror image of what you were already doing, except you're using Reg A plus to raise money, potentially at larger amounts. And the other thing I wanted to respond to you on is that, given that Fundrise exists and is doing such a good job, because they've raised approximately, as I mentioned earlier, they've raised a lot of money. I think it's attractive for small real estate developers to go to them and see what their terms are. Because in that space, that they're offering good deals. You know, for companies that are talking and planning and regularly doing larger transactions, then it makes much more sense to do your own Reg A plus offering or offerings, and have control and don't have two sets of fees, because you want to be able to charge fees yourself. You don't
Sure.
want to be paying two sets of fees.
Right. Okay. Interesting. So talk to me a little bit about the real estate investment trust, the REIT or the E-REIT, you know, that you mentioned in the opening. How does that work with Reg A plus?
So I would say that at its most basic, an E-REIT is just the same as a regular REIT that you see publicly traded, but, and again I'm going to use Fundrise as a good example here, even though Reg A plus shares are, as far as the SEC is concerned, liquid post-transaction.
Sure.
Fundrise has wisely locked the shares, so they're not liquid. But then they provide quarterly liquidity, which is limited because it's a REIT, and it's limited anyway. Certainly whilst you are raising money, you can't be liquidating investments simultaneously, because that would cause a conflict.
Sure.
So that amount is microscopic whilst you're raising money, and it goes up from there when you have raised the money. Point is, you're providing a reasonable liquidity path that exists, that isn't dependent on new marketplaces evolving, which they are, and that structure of the REIT is defined and known, and the differences are that you are not using brokers to as a part of the buying transaction, so you save a lot of fees there, and that's actually probably the biggest thing. You know, and then when it comes down to what is the minimum investment amount, you know, then you're going to tune that according to your experience or your preferences. Some people have found in real estate that enabling very small investment amounts isn't wise, because people don't think of it as an investment. They put $200 into something, and you need them to sign a document and get it back to you promptly for an audit or whatever it is. They don't even remember making the investment. It's not interesting enough for them to act.
Sure.
Right. Whereas, so setting a minimum that's a little higher, perhaps, on some of these real estate deals, maybe $1,000. Where I wouldn't say this for a company that is a consumer-based company that has a gadget. You know, that would maybe be a lot smaller number, like Brewhouse. You know, theirs was $95 minimum. Okay.
Interesting. So, since there isn't a requirement for a broker-dealer being involved, you know, but you do have to provide liquidity, theoretically provide liquidity, but you don't have a network of people kind of making a market in that stock. You know, how is that done?
Okay, yes, that's a great question, actually. So you are not required to provide liquidity. It's advisable to make the investment more attractive to the investors.
Okay.
If you say this is a 10-year project and you're in it and you're stuck and there's no way out, then, you know, that's going to turn off a lot of investors.
Okay.
So that's the reason to do it. But what's interesting here about Reg A Plus is that I believe the SEC crafted a really sensible set of rules for reality, which is some companies are raising smaller sums and they don't want to list anywhere. And they'll be really happy when it's easy for their investors to transact sales of their shares. And there are marketplaces coming along that will do that for non-listed shares.
Okay.
I mean, not on the OTC or anything.
Sure.
So that's one option, and the other option I just mentioned of locking the shares altogether, those options exist because you don't necessarily have the performance right now that you want to be having to justify big fluctuations in share price.
Sure.
Then there's companies that will choose to list on OTCQB, which is an automatic, if you do a successful Reg A plus transaction, Tier 2, which is the lion's share, you can list automatically. It's $6,000 they raised the price for a new ticker symbol, and now you need market research, you need a research analyst service, which we're building to make that cost effective. Some companies will list on the QX, where now they have to report quarterly instead of once every 6 months.
Yeah.
Still an annual audit. That zone, whether it's on the OTC markets or others that don't really exist right now, there are markets that in Canada that are coming along that might be nice alternatives. Right now, though, you've got a very low reporting obligation relative to being a public company.
Sure.
On the,
talk to me a little bit. I mean, you mentioned, you know, Tier 2. What's the difference between Tier 1 and Tier 2?
So Tier 1 is where you do not have any exemption from filing with every state that you raise money from in order to get their approval. And that is a very expensive and time-consuming process with some states. So you wouldn't want to raise money in Tier 1 from 20 states because it would probably cost you so much money for the legal services to file with each state. Some of them are just going to bog you down. Some of them are doing merit-based review where they decide if this is a good risk. So, you know, all bets are off with that. Banks have dominated Tier 1 so far because these are community banks, generally local, and they have some exemptions from state regulation when it comes to raising money.
So this is banks raising money as a bank?
As a bank, yes.
Okay.
Yeah, so that's the most common use of Tier 1, like 90% of Tier 1 so far. Tier 1, interestingly, is very attractive for companies outside the US if they're not going to raise money inside the US, because now you don't worry about the states. That's an unusual case, but it's Tier 2. They both start at 0, and Tier 2 goes up to 50 million, Tier 1 goes to 20 million. And Tier 2 has got the disadvantage that there is a reporting obligation of an annual audit and 6 monthly profit and revenue reporting. Tier 1 doesn't have that obligation. That's the reason why Tier 1 is exciting. You don't have to have an audit to do Tier 1, but it just doesn't fly so many of the times.
So there's no requirement to take your company public if you do a Reg A Plus offering?
Correct.
Okay. So we're here with Rod Turner, the chairman and president of Manhattan Street Capital, an expert in Regulation A Plus. We're talking about Reg A Plus as it relates to real estate transactions. We are taking questions if you have any, and we'll address those as they come up. So how do you organize a real estate offering?
So most of these guys in the audience already do and know, but do you mean the Reg A Plus aspect of it? Yeah. So,
you know, testing the waters and kind of those aspects of things.
Right, okay. So testing the waters, for those that aren't aware, is a aspect of Reg A Plus where companies are allowed to put their offering up in a test mode in order to find out how much interest there is from investors. It's been used up until now as a part of a rollout. You know, you're spending the money, you've got all the service providers locked in, and you're moving ahead, and you do the test the waters thing as a way of getting reservations and prepping the market. In my view and in practice, it turns out to be a remarkably expensive way to do that, because once someone's made a reservation, now you have to go back to them later when you open for investing and persuade them to come back and sign up now. And that happens, but it's expensive. So I personally recommend against doing test the waters in that form. We've introduced last week a thing called Reg A Plus Audition, which is test the waters by another name, where we package marketing services with this test on a low budget. So that companies can do a 2-month test where we're not trying to shoot the lights out. We don't have all the other service providers already on board. We're evaluating if to do a Reg A Plus.
Do you have to have completed your audit, and you know, and so none of that is required?
Nothing is required up front, except that we stick within the rules of not over, no hype in the marketing. No excessive hype. Like, you can't say this building will revolutionize habitation on the planet. Right, fair enough. So our Reg A Plus Audition is a package really of listing the offering on our site on Manhattan Street Capital and marketing services to inexpensively test messages, test the offering, and engage our community, which is not an overnight thing. We'll be doing a bunch of things to engage the community so that people can find out easily and inexpensively if they should do this. You don't have to have the big budget marketing plan to find out if it's going to fly, because it's a matter of percentages. As you know, as anyone, when you have the marketing experience these days, digital marketing can be done very cost effectively.
And you can actually get a lot of data. I mean, you can get even some statistically significant stuff, if you know how to structure things properly, and you can do a lot of A/B testing, seeing what messages resonate with audiences. I think that's really good.
We do have one question.
Go ahead.
Avi wants to know, what are the total costs and the breakdown for, say, a $5 million fundraise for a REIT on Reg A with about 100 investors Manhattan's fees, PR fees, SEC costs, legal, audit, and
Okay
anything
then,
else?
I touched on part of this. With a broker-dealer, that the total cash costs will amount to approximately 10% of the amount raised. It could be higher on a smaller raise. You wouldn't raise $2 million.
Yeah, they're going to have thresholds that they
Yeah,
won't
so
even touch.
I say 4 million is the minimum where you should use Reg A plus. So, and if you don't use a broker-dealer, then the cash costs will be about 6%. Roughly 6%, which is a very low total cost compared to other
For
options.
that amount of a raise, for sure.
Yes.
I mean, that's very low.
Plus warrants, but again, cash costs, we're talking there.
Yeah.
So in terms of upfront costs, I mentioned some. So 100K is at the low end of the range. For a 5 million raise, which is getting a little tight, the percentages might be a little higher with a 5 million raise. The upfront filing key, the cost of the audit is going to depend on how long the business has been around. And the cost of the legal service is the same. That isn't changing with the
So
size.
kind of in that 50,000 range.
50K, yeah.
Okay.
And the cost of marketing preparation will be less because it has to be. Because
When it's a smaller target
when it's a
audience,
5 million raise.
Yeah.
So the total cost of marketing tends to be 2 to 4% of the total raised. Not front loaded, I mean totally loaded,
Sure.
including the whole thing. It's not charged as a percentage, of course, but I'm just giving you a broad
how the
strokes.
numbers break out.
Yeah, how it works, yeah. So how it will turn out as the mix of the fees depends on the minimum investment amount and the nature of the investor mix we get. 100 investors for 5 million implies a large average investment amount. So our Manhattan Street Capital fee would be a low number at $50 per investor because that's what we charge. If someone puts in if someone were to put in $1 million, we get $50 plus $50 of warrants, and so tough, we don't have such a big return on that one. But I think I've hit the numbers there sufficiently.
Yeah, I think so. I mean, there's no, definitive answer. I mean, a lot of it is really depending upon your company. I think the audit could vary a lot.
Yes.
Depending upon, have you had audited financial statements for the last 3 years, and
Yes.
you're just like doing a prep audit, or you're going to go back and do forensic accounting on everything.
Right. So it's a 2-year audit requirement,
Yeah.
but you're right. If you've already done that stuff repeatedly, then it's a much
Yeah.
easier step. A lot of companies are setting up a new entity to keep life simple for
Yeah.
and if that can be done, that can be done in almost every case, but it is itself a step, right?
Yeah, I remember when we took Entropic public, we made the decision. So we took Entropic public in December of 2007. So at the end of 2006, it was pretty clear we had kind of exceeded a valuation that an outside, company was going to buy the company. There was just a disconnect. We were going to be a higher valuation if we took the company public as opposed to an M&A transaction. But I still felt like we were subscale, so we bought another company. They ended up having their shareholders had about a third of the company, and we had 2/3 of the company, the historical Entropic. But that delayed the SEC process by 3 months, 4 months, because it was complicated. So, it's one of those things where if you're kind of cobbling together a bunch of real estate firms and you've done a bunch of M&A and you haven't gone through a whole audit cycle related to that, it's going to be more expensive and it's going to be more time consuming.
Right.
So, these things can come up. So what's part 2 of the question?
Does Manhattan Capital have direct access to its own investors, or Manhattan will solicit from the open market?
Okay, good question. So we have a small investor base because we've been focused primarily for the last 2 years on bringing in companies, and we have only done one offering so far, which was Blue Marble. We've been very selective as to what companies we want to work with because we want them to be successful in the aftermarket and have them be successful in their raise. So you wouldn't. The truth is, though, our competitors, all of the platforms, have small numbers of investors relative to the need.
Sure.
So in an ideal world, and maybe we'll reach this point not too far out, maybe a couple of years, when you have a large enough investor base that loves your business, that is the platform, when you put a new offering up, then will be lovely because a lot of the investors will come because they love the reputation and the track record of the offerings we've already done. That is my aim.
Yeah.
And when that's the case, then they'll have a predisposition to look at any new offering we put up because it's a Manhattan Street Capital deal.
Sure.
That's what we aim for.
Yeah.
Having said that, that's the bottom line. Today in Reg A+, it's new enough. Nobody has a critical mass of investors. We do not solicit investment because we are not a broker-dealer. So the agency does that. And when we have more than one offering, then the technicality is with more than one offering live, and we have a real estate offering live right now, then we are able to market our list of offerings. But we're not allowed to say, go for this one. This one's the best one.
Yeah.
Put your money here.
Right.
Absolutely not allowed to do that.
Yeah. Well, I mean, even if you look at, like, you know, as you know, I recently did a Kickstarter for my book, my new book. So you know, if I just went in there and said, okay, I'm going to plot my book on the site and expect it to generate, it doesn't work that way in crowdfunding. And
Right.
even in crowdfunding, the platform gives you access, but you have to do your own marketing. You have to, you know, basically build your own momentum, which brings up an interesting thing. Like a lot of what I did, the pre-work was like a month before I actually launched on Kickstarter.
Yep.
And some of these other guys have been massively successful on Kickstarter start 6 months ahead in terms of kind of their marketing. You know, this is, you know, pre-sales crowdfunding compared to equity crowdfunding, but what are kind of the rules around that for how soon can you go out and say, you know, I guess it could be considered a general solicitation as soon as you like blast out an email to 1,000 people and say, hey, I'm going to be on Manhattan Street Capital making an offering, you know, in 6 months or whatever. So what are the rules around that?
Well, Test the Waters allows you to do that without a time limit. So if you want to do that for 6 months or a year, you're allowed to. Is it cost effective? You know, when does the cost effectiveness peak and drop off a cliff?
Okay.
You know, that's a different issue. And it depends on the nature of the offering. Certainly there have been companies that went live with their Reg A filing, waited on their new audit for 6 months, and then went back to the reservation holders, of which in one case 22,000 of them, it was dead. And because the early adopters, the people that made
their investment, they had dry powder. They've
gone. You know, they're on vacation. They've forgotten. You know, they've changed their interest. For Christ's sake, they've got a new hobby in 6 months.
Yeah, I mean, I've even looked at, you know, it's recently some investment property from high net worth individuals and using kind of a hard money lender to be the broker. And he's like, until we get within 30 days, I can't lock down an investor because you know, interest rates are changing and they've got other investments.
Have to review it all over again.
So it's really interesting.
It's a mixed bag. On the audit front, be careful, because there are some auditors that will take you all the way down to some pivotal point where it's too late to switch and then tell you it's going to cost you an arm and a leg more, like 4x, and take a lot more time. Got to protect yourself against that. That's huge. There aren't that many, but they do exist.
I think that the main point I was trying to make relative to kind of comparing Kickstarter Manhattan Street Capital is, you can have a platform, it can have a wide reach, it can have a good brand, it can have respectability and have a strong reputation, and that's the kind of platform you want to be on. At the same time, you got to do your own marketing.
Right.
You know, if you're just expecting to kind of jump on there and
it happens on its own.
And I just don't think that's a realistic
There's a lot of work involved altogether.
It's huge. And you know, even in my Kickstarter, I was doing outreach every single day for 30 days in a row. Like probably 2 to 4 hours a day during that 30-day period of the crowdfunding campaign. You're smiling and dialing, you're doing everything you possibly can do to kind of get that thing going. Just like when you took Entropic public, you know, we were on the road for 2.5 weeks, you know, for the IPO roadshow, and we're flying all over the country, fly to Europe, you know, do all these different things. Investors want to see, you know, you and that kind of thing, but that's kind of the bigger thing, is like the skepticism around, will the online platform work? Well, you know, at least in real estate, this has raised $160 million in a very short period of time, so it does work. So anybody that's saying it doesn't work is kind of burying their head in the sand.
Right, which is, you know, people come from their, you know, they come from their background, and that biases their perspective. But I wanted to touch on a couple of things in response to what you just said. The nature of raising money when you're doing it through equity crowdfunding, the size of the offerings are large enough, with Reg A Plus anyway, that you can afford to have the agency do a lot of work. So not to say it's easy and you can just sort of sit back and go on remote control, but It's better in that way. You know, a lot of the
But you do have to invest in an agency.
Oh, absolutely. That's
Yeah.
cash cost, right?
Yeah.
That's the single biggest expense. Unless you
Yeah.
have a broker dealer, and then you're happy if it's a very big expense because you're paying them a percentage.
Right,
And
right.
that means they brought in a lot of investors.
Right.
Right.
And they're doing the marketing as well as the brokering of the deal.
Yeah, but again, only when we've already made it a success at retail. Because
Okay.
you can imagine, when you think about the broker dealer rep who's got clients, he is not going to go out on a limb and suggest that they invest in an offering until it's already no risk.
Sure.
It's already got to be successful.
Sure. Yeah.
Yeah, he's not
Good
going
point.
to.
That's a really good
He doesn't
point.
want to have the follow-up discussion where it was the other way around.
Right. So is Reg A Plus available for companies whose operations are outside the U.S. and Canada?
Yes, as long as they set up their legal headquarters in the U.S. or Canada.
Okay. And then one of the things, like every company I've been involved in, including QuestFusion, is we're incorporated in Delaware. Because there always is a chance you raise outside capital. The investors that I would be dealing with are familiar with Delaware law. We could have incorporated in California, and a lot of companies still
Right.
do that.
Right.
Maybe they're an S corp or
Right.
maybe they're an LLC in California, but because there's the potential for raising outside capital for this, do you have that same kind of situation
Yeah.
with
Yes.
companies you're dealing with?
Yeah, so Nevada is gaining popularity, but Delaware is still the big name
Okay.
for the same reasons. And you can raise money from anywhere in the world. You're not restricted to the U.S. And to go back to the implied questions there about the platform stuff, there's a lot of work in increasing the efficiency of the close rate. So the marketing agency delivers a flow of interested people, investors, and some of them will look and come back, and some of them will, when they are ready and they start the investment process, making that process as smooth and as easy as is humanly possible is huge.
Yeah, it's massive.
Absolutely massive, because you can see it where it looks clunky and they got too many questions, and then they repeat the damn questions, and anyway they're invasive questions.
Right.
Where you may get 10% convert. Right?
Yeah.
So in our case, what I was really pleased with is that our conversion rate from entering the investment process to completing it with money in escrow was 50% when we did
very
it.
good.
In Marble. Yeah, I was
Very
ecstatic, and I am. But there are more things we've got to add there because for example, millennials don't always have a checking account, so writing a check or ACH isn't going to work for them.
Yeah.
And offshore similar. So debit cards are something that I'm working hard on to build into the platform so we can make it easy
Okay.
for millennial investors.
Well, I think we hit on all the high points here. Are there any kind of closing remarks you have, kind of things you want to leave with the audience out there?
Yes. So I guess what I would say is that we're at the early stages of Reg A Plus as a whole. So bear that in mind in your considerations. Don't just leap into it. But as a segment, real estate is the best established segment, and we're getting to more investors that are active.
Sure.
The second sweet spot I'm seeing makes it clear that the second sweet spot is people that are almost accredited. So they haven't been able to do these deals forever, and now they can. So when you get a larger investment amount, it tends to be, some accredited investors, but
Sure.
mostly it's the almost accredited because, wow, I can do this now?
Yeah.
So there's a 20K investment.
Yeah.
Right? Whereas the consumer who loves and believes in the company might be putting in $1,000 or $2,000.
Yeah.
So my point there is that for Reg A Plus, the most established sector is clearly real estate. So
Yeah.
you have a lot less risk of failure because by its nature it appeals more to consumer investors and to people that will put in a little more, some of these almost accredited folks.
Okay, terrific. This is Patrick Henry, the CEO of QuestFusion with The Real Deal What Matters. Again, we're here with Rod Turner, the chairman and president of Manhattan Street Capital, an expert on Regulation A+. Make sure you check out the Manhattan Street Capital site. And how do people get a hold of you, Rod?
So my email is Rod, like Rod Stewart, Turner, like Tina Turner, at manhattanstreetcapital.com, spelled the way it sounds. And you can go to the website and click on any of the touch points there, and mostly the companies will flow through to me at this stage in the game.
Okay, awesome. Well, thank you so much. This has
Thank you,
been great.
Patrick. Thank you very much, everybody, for being online with us. I hope this was really useful for you. And let us know what we didn't cover that should be covered, and if we covered something that shouldn't be, too.
Awesome. Thank you so much.
Thanks, Patrick.
You bet.